all the time, which is you people keep saying things like, it's going to be like there's going to be a shortage of coins. There's all this buying pressure, and there's so few coins on exchanges or so few coins XYZ. But the variable that always surprised people for some reason is that when you do go up multiple times, you get selling into that. And I think we've entered the phase, and we're going to continue to be in the phase where it's not new mining supply that really kind of impacts price.
If you look back at Bitcoin's price history, 2011, 2017, 2021, and now 2024, you'll notice the same signature. Each major bull market peaks when long-term holders begin distributing coins into strength. This isn't manipulation, it's a structural reality. When Bitcoin hits new all-time highs, liquidity deepens. Buyers flood in, driven by headlines, ETFs, and institutional validation. And that's precisely when older holders, many sitting on gains of 10x, 50x, even 100x, begin to trim their exposure.
One of the challenges, of course, is that's in dollar figures. And as Bitcoin gets much larger, of course, the dollar figures for almost everything are going to increase. And if you notice, like the spikes were during major bull markets. So 2017, then 2021, and then 2024. These were kind of periods of major new highs. And what happens historically, we have kind of data of this going back to like 2011, kind of every major bull cycle in Bitcoin's history, is that you get selling pressure from longer term holders when you're kind of reaching new highs, and that there's plenty of liquidity to sell into. If you try to sell into a weak market, you get a lot of price slippage. If you're a meaningful whale and you're trying to sell, you generally want to sell into a bull market to kind of sell, and your coins are easily bought by new buyers. I do think that the narrative like the IPO is correct, but it's not unique to the cycle, which is to say that there's some aspects unique to the cycle, but basically you do get that kind of gradual distribution from very early adopters, much like a startup company becoming, a publicly traded, widely held entity. And basically the difference is that Bitcoin is not a security and it's always been public, but you still get that kind of same sort of investor behavior where you get, kind of super high signal early adopters, and then you get kind of people come later. They've seen more patterns of it. They've had time to kind of analyze it. They have less explosive upside potential, but also, generally less risk by the time that they buy in. And one way to kind of capture this is like people that have been holding for many years are often up 5, 10 times or more, depending on how long they've been holding. It could be many times more. Many of them have, they've aged a number of years. Many of them have families that they didn't have when they started hodling. Many people want to just upgrade their consumption patterns. Some people get nervous by having, what has grown to maybe 90% of their net worth or more in an asset, and they might still love the asset, but they might say, well, there's no other asset I'd even put 10% of my net worth in. I got 90% of my worth in this one. Maybe I want to go down to 50. So I'm still bullish, but maybe I'm not, betting the farm anymore on one thing that they could chop around and do all sorts of stuff. So you get any number of reasons that are pretty valid for people kind of distributing. Sometimes you also have someone that distributes back to themselves, which is they say, I've been self-custodying, what is like now millions of dollars, and maybe I still want to self-custody a bunch of it, but maybe I don't want to self-custody all of that. And so you get kind of potentially selling into ETFs or treasury companies that then that same individual or group continues to hold, just in a different form, which can potentially give them kind of different types of liquidity access and stuff like that. And so I do think what's different with this cycle is that you do have, obviously the ETFs and the treasury companies present new opportunities for the types of selling and distribution that can occur. But I think this is part of a broader kind of pattern that happens, and I think will continue to happen in every major bull cycle. It's kind of part of that natural distribution process. And that's also why I tend to be on the bearish side of bullish all the time, which is you people keep saying things like, it's going to be like there's going to be a shortage of coins. There's all this buying pressure, and there's so few coins on exchanges or so few coins XYZ. But the variable that always surprised people for some reason is that when you do go up multiple times, you get selling into that. And I think we've entered the phase, and we're going to continue to be in the phase where it's not new mining supply that really kind of impacts price. The question is, at what price can you unlock, tightly held coins or previously tightly held coins to get them circulating? And so you have all the different demand sides, liquidity, regulatory changes, perceptions of the asset, all that type of stuff is on the demand side, and the supply side is basically either, for the most part, it's older holders selling into strength and liquidity. That's the most common. And then in rare moments, you get these longer term holders selling into fear. So, for example, that kind of bottom in 2018, you had a rare OG selling into weakness moment. There are a couple of moments like that can happen as well.
The bear whale.
Yeah, you get kind of capitulations. But for the most part, it's older holders selling into periods of strength and distributing the coins.
This process often surprises investors. Many forget that even in times of perceived coin shortages, the real variable is not mining supply. It's how much of the existing supply long-term holders are willing to release. Every cycle, liquidity returns faster than expected, often catching overly bullish traders off guard.
Fast these things can change. So a lot of this is not surprising. I guess the part that surprised me a little bit is how quickly things can change in like a few months. Back in like June, Metaplanet was touching an 8x market multiple to net asset value. And then just a handful of months later, it's like bouncing, at or around 1. And so at the time, I was like, well, I wouldn't buy it at this multiple. But if it came down lower, I'd be interested. If you would have asked me at that time, will it be like 1-ish in just a handful of months? I'd be like, no, I expect it to be lower, but I wouldn't have guessed that it'd be 1. Maybe I'd be like 2 or 3 or 1.5 or whatever the number is. Same thing with strategy. I tend to get, whenever it's the kind of the brief times is hit like 3 times MNAV. You generally see at the same time that Twitter's like very euphoric about it, saying, why couldn't it go to 5? Why couldn't it go to 10? Why couldn't it, this is actually what the MNAV should be. And I tend to get nervous around those periods. I tend to get, more comfortable when it's like, a firmly sub 2 MNAV. But again, if you would have asked me, would it go all the way down to 1.2-ish MNAV by this point? It's kind of, go maybe quicker than I would have guessed. Even though I think that it's, in a debate with Andy Constant, I mentioned that my estimate range for an appropriate MNAV is something like 1.2 to 1.8 for them. So we're kind of currently at the bottom end of that range. We could certainly go lower. My general view is that a successful treasury company, if you're a pure play, meaning you're not just a company with cash flows that happens to stack Bitcoin, I think the market for that is endless, basically.
Yep.
If you're kind of known as a treasury company and you have thin operations and the main thing you do is stack Bitcoin, generally speaking, you want to be the number 1 or number 2 in your market, depending on how big that market is. Because if you're an also ran, that gets challenging. So and market in this phase is basically what the currency market or the capital market you operate in. Or sometimes that could be modified by a company that's willing to operate a little bit differently. Maybe one company says we'll never buy back shares. Another company says we absolutely will buy back shares if the conditions warrant. So you can have kind of different. You can have ones that are perceived as more aggressive or more defensive, that could kind of give you some wiggle room in terms of what position you could be in the market. But where I get nervous is that long tail of companies where they're not necessarily doing a ton different, and they're not the most liquid and largest and safest, because there are liquidity network effects at play. So I think there is a market to have treasury-focused companies in the major capital markets of the world where regulators are fine with it. But beyond that, I think you generally want to look at companies that have operations as well, or obviously just holding Bitcoin and letting that do its work.
Yeah. What do you think about these new preferreds in particular? I haven't looked into them, so I don't know if you have either. Have you had a chance to see how these are structured, or what kind of markets Sailor's focusing on here with the stream preferred?
Not super closely. I mean, I see that they launched that Euro offering, which makes sense. That's a very big, it's the largest treasury company entering, what is other than China, the second biggest currency market out there. And so I think that makes sense. The size is modest relative to MicroStrategy's overall size, but I think it's a step that makes sense. I haven't strongly looked into the other one yet, but it's a general thing of you generally see the largest ones they generally have market access that the other ones don't. It's kind of there is a benefit here from being at scale. You can absorb the cost and complexity, and then you have the liquidity to be able to offer things like this.
Yeah. John, anything on the topic?
Since we're talking treasuries, maybe we just highlight as a news item, Strive announced SATA, which is their preferred. So there's another US dollar preferred in the market. And yeah, I think this is aligned with the thesis that there will, my thesis personally, anyone's entitled to their own view, of course, but I think there will be successful Bitcoin Treasury companies over the long term. It's up for debate how many of them there will be in any given jurisdiction, which financial products that they offer will be the most successful. Will some of them blow up for some sort of reason? Of course, all these things are good questions to ask. But Strive announced SATA, which is a preferred. They announced it at an $80 price to entice investors to come in on the IPO of that instrument. And I believe it's a 12% coupon. So I think it's just interesting to see competition, I guess you could call it, from issuers in the Bitcoin Treasury company space for issuers of this, what's now being called digital credit. So Strive certainly seems like an entity that's in it for the long run. So they now have their SATA security perpetual preferred out there as well.
But there's a hierarchy forming. The largest treasury companies, those with scale and credibility, enjoy better access to liquidity and capital markets, just as blue-chip corporations do in the fiat world. Smaller imitators without that scale or reputation face greater risk and thinner margins. This is where Bitcoin's next evolution will play out, between pure-play treasury companies and hybrid models that combine operational businesses with strategic Bitcoin reserves. The winners will be those who maintain balance, leveraging Bitcoin's strength without overextending into speculative frenzy